Well, thanks for coming on.
Thanks for having me. I appreciate it.
It's nice to have different voices in the field. I think, it would be great, real quick, just for you to tell everybody a little bit about yourself and RailField, and then we'll dig into it.
Sure. So I'm Jon Siegel, and I'm one of the founding partners. I'd say that founding partners and chief investment officer is my long title of RailField. So that we have 3 partners at RailField. I'm one of 3, and we're a multifamily ownership company. We own a multifamily in the Mid-Atlantic, Southeast, and Texas. And I like to say now I've been in commercial real estate for longer than I would care to admit. I've been on both sides. I was a principal, then I was a lender. I worked for what was the largest owner of multifamily in the country. I just got that job out of business school.
Who was that?
It's called NHP. So it was in the 1990s. I'm old. I think the gray hair maybe doesn't show up, but it was called NHP, and we had about 150,000 units, and then it actually ended up getting sold to Aimco, which was a REIT, which I think doesn't exist anymore either. It has a different name. And so when I did that, I left there and I went to Fannie Mae. So I worked for the largest lender. Mm-hmm. And at Fannie Mae, I did what they call the structured transactions, so the big complicated deals. So the biggest one we did was $8 billion. So we did sort of the big deals. Mm-hmm. And then I had enough of the big company thing and wanted to do my own thing. And so along in winding road, we ended up starting RailField in 2013.
And you met some of your partners, right, from Fannie?
Yeah, so I have 2 partners. Ken Bacon, he ran multifamily at Fannie, so he was the big boss guy.
Okay.
And so if you had told me actually when I worked at Fannie, when I was one of the peons at Fannie, that Ken, the big boss guy, was going to be my business partner, I probably would have said, probably not.
Yeah, that's got to be pretty cool.
Yeah, that was pretty wild. And then Todd, who was one of my colleagues at Fannie. So Todd and I actually left before Ken. We had the entrepreneurial itch, and we picked a bad time to leave, which was during the great financial crisis. So maybe not the most inspired move of a guy that had 2 kids, but we did it. And we made a go of it. We were trying to buy deals, and it was really tough. And so we ended up doing a lot of advisory work. Just everybody we knew called us and said, "Hey, will you do this deal for us? We do this."
So doing whatever you can do to get fees.
Just make money, keep the lights on. And then one of the people that called me was Ken. And Ken said, I'm thinking of leaving Fannie. What are you guys doing? And it was funny because all of the big boss guys were calling us like, "What are you guys doing? How do you do that?" And so Ken ended up leaving, not with any plan of doing anything with us. And then one day he's like, "Hey, you guys want to get together?" And so, he was like the big boss guy. So of course we'll get together with you. And so we went and we had breakfast, and he says, so Ken he's on the board. He's on a lot of corporate boards. He's on the board of Comcast, a lot of big companies. And he was on the board of a company called Artemis Real Estate Partners, which is a big investor. And Artemis was pretty new at that time. And I think as pay for being on the board, they gave him an office. They gave him a place to go because I think his wife didn't want him around the house after he had left Fannie. Yeah. And he was trying to figure out what to do also. And so Artemis actually, is a private equity firm, but they had gotten this arrangement with New York Common, the big pension fund. And, New York Common, I would say, has like 10 employees and like $1 trillion. So they can't put money out. They have to give somebody like $500 million at a time. Mm-hmm. But they were looking for a way to put money out in smaller chunks to smaller companies. And so they call it their emerging manager programs. And now there's a lot of them out there, emerging manager program. And Artemis was going to run it. And so I think Artemis was giving the money to the same people that New York Common was giving it to, just trying to do safe deals. And I think New York Common said to Artemis at one point, like, "Hey, like you really got to do like with an emerging manager, maybe like a startup, maybe a company with a minority ownership, something like that." Mm-hmm. And so they were like, So they yelled across the hall, "Hey, Ken, you ever think of starting a multifamily company?" And Ken's like, "I don't really want to go out and raise money. That's kind of a hassle. I'm not really sure what I want to do." And they're like, "Well, you don't have to raise money. We have money." So he called Todd and I, because Ken's a big shot. He's not like going to go do a model or like go tour a property or whatever.
He's high level.
Yeah, he's 100,000
Yeah, the guy didn't want $500 million and they just threw it into his lap.
Yeah. So we didn't get 500, but we got $50 million.
Talk about being in the right place at the right time.
Yeah. So it was funny because they said, "Okay, give us a business plan. And if the business plan was to say that you're going to buy core plus properties in Texas, we might give you the money." And so we're like, naturally, we're sitting here in Bethesda, Maryland.
They wrote the whole script. They literally wrote what they wanted.
They told us what they wanted. And to be fair, I've been in the business a long time, and we had done deals all over. So it wasn't a huge stretch, but, we're sitting in Bethesda, Maryland, and we're like, well, that's Southwest amazing. Airlines, here we come.
Well, so Ken kind of joined you guys.
Yeah, so Ken said, "You guys want to do this?" And we're like, "Yeah, sure. This is what we've been trying to do." And so, so I like to say we started on third base. I mean, most companies that do what we do, are syndicators. They'll call everybody they know and raise money from, people at the country club or whatever. And we got institutional
on Instagram.
Yeah. So, and we got institutional capital. So but naively, of course. So we got this pension fund money. And we're going out there, hey, we got pension fund money. And we bought a couple of properties in Texas.
What does that feel like? Yeah, I mean, that must be a great feeling you're really kind of trying to scratch together everything you can scratch together. And then suddenly you get some big checks coming at you.
Yeah, all of a sudden we were sort of like, wow, we're actually doing this.
Yeah. And do you have more confidence as you're approaching?
Yeah, sure. I mean, if we're going to try to, like, when Todd and I were trying to find properties, we're like, oh, we'll buy a 60 unit deal in the suburbs somewhere, and then all of a sudden we're like, well, we have institutional capital, we have to put out $20 million equity check or something like that. So yeah, I mean, and it gave us instant credibility because and also this was 2013, so the cycle was just starting. So people, like you're a broker, like if somebody comes to you now and says, I have money, you're like, yeah, so does everybody else.
Exactly.
Right?
It's kind of like
at that point, it was
broken record.
Right. So, but at that point we actually had money. And so we bought a couple of properties and we were like, we have pension fund money. We'll spend this money. It's $50 million. We'll spend it. And then we'll just go to some other pension funds and we'll just take it from there. And, I'll be retired on the beach in 8 years, whatever. Well, it turns out that most pension funds actually don't want to give money to three guys sitting in a room that have a couple of deals in San Antonio, who've never round-tripped a deal. So we were sort of like, Artemis was like, okay, yeah, you guys did a great job putting the money out. And now let's see what happens. Let's wait and see how these deals go. Can you actually deliver on your business plan? And so we're like, okay, so what do we do now?
And what's the hold period on these deals?
I mean, it was supposed to be 7 to 10 years.
Okay, so
it didn't end up being any. We sold them pretty quickly.
Sure.
But yeah, so we're like, okay, so what do we do now? And we and Ken is an institutional guy. We call ourselves sort of a small institutional firm because we all work for institutional. But he was like, well, we'll call some more pension funds. I was like, I don't think any pension funds are going to give us money.
And that's because you haven't gone full cycle yet?
Yeah. I mean, people were like, hey, yeah, you guys have good backgrounds.
And then Ken went to the beach and got a $200 million check.
Yeah, exactly. Right. He retired. And now we sort of wandered in the desert for a little bit. And then, we had done a business plan, and our business plan, of course we put in the part about Texas, but we had sort of said like, what we really believe in is, workforce housing, and we define it as 60 to 120% of area median income. So that's sort of a deep part of the multifamily market. You're below the Class A, but there's a lot of renters there. And we actually said, like, what markets would be good? Because actually, when we first started doing it, they're like, hey, you got money, major markets of Texas. And we started looking at deals in Houston, which, in retrospect was probably not, and no disrespect to Houston, we have a property in Houston, but it was probably like, And we were sort of like, what? And I was sort of like, what makes a good market? And we were, everybody says, oh, Dallas is a great market. And I'm like, why? And they're like, I don't know, because it's a great market, because everybody says it's a great market. So we actually did some math. We set up this little model. I don't want to overstate it because, I'm not a data scientist. But we set up like 10 data points, and we said, okay, what makes a good market? What would make a good multifamily market? Like in migration, gen or millennials at that time, that kind of stuff. And we did it, and we said, what markets are really good? And some of the markets we thought were great sucked in that market. Like Birmingham, Alabama, again, great place, but Birmingham, Alabama, we're like, that's a great market. They have all those auto plants there. Sucked in the index, like numerically. So we're like, okay, let's not look in that one. But like San Antonio came up with a good score. Richmond, Virginia, like a couple of places. And so we had done all this work on the front end. So we started saying, okay, well, let's look for properties that sort of fit the criteria of in that sweet spot in those markets.
Yeah.
And we hooked up with we did a one-off deal with just a garden variety private equity firm. We did a one-off deal with a family office. We did a couple stuff, and then we sort of worked our way back to institutional capital and coming up with some good relationships. And so we're sort of back in the.
It's kind of interesting. You kind of have one foot in both worlds a little bit. It sounds like, which gives you, I imagine, some optionality. And
I mean, at the time back then, I said. Man, I have a lot of deals and I don't have any money.
Yeah.
And now I feel like it's a little bit like, I wouldn't say, I don't want to overstate it, but I'm sort of like, we have capital.
Isn't that interesting?
Yeah, but I can't find any deals now.
Yeah. You're spot on right now. Everybody's like, we're sitting on a lot of powder. Like we're ready to do deals.
Yeah.
But everyone tells you the same thing.
Right.
So I mean, you have people like Howard Marks saying that there's still a ton of opportunity in private credit, but people need more realistic adjustments to what the correct yield is. Like, what's your take on it?
And so private credit's interesting because everybody now, went from like, hey, I want to buy value add multifamily to I want to be in private credit. Yeah. And so like we hear from our institutional joint venture partners sometimes like, hey, we have this. I'm like, hey, this is a good deal. We have it. It's a 14% IRR, which is well within the box of what we're supposed to do. And they're like, I could do a pref deal of 13% and not take equity risk. So
point.
why would I do that?
How do you argue with that?
I don't know. We have a joint venture to do it, and I want you to put out the money so we can, have some more deals. But I like to say also that everybody is either giving pref or getting pref. Although I question how many deals are really getting done. But we've actually done a couple of preferred equity deals as the lender, opportunistically. Like we came upon some stuff, and we've done a few of them just because you can get theoretically 13-14% IRR and not take.
I don't blame those people. I'm starting to really question how many of those deals exist.
Yes, I think you're right. Yeah.
Still mailing paper checks and leaving voicemails like it's 2003? Your investors aren't looking for nostalgia. They're looking for their distribution status. InvestNext brings your investor experience into the 21st century. Branded dashboards, automated updates, and no more 9 p.m. phone tag. Scale your capital without scaling your chaos. Visit investnext.com/nocap to build investor trust without the burnout. That's investnext.com/NOCAP.
What's the reality? I'm looking at equity deals constantly.
Yeah.
It's as tight as it's ever been.
Yep.
What's your take?
Yeah, I think it's interesting. I think so. Everybody plowed into private credit and said, "Hey, we can do." If you take a step back and look at it and you say, "Okay, how many loans are maturing?" People did all those deals in 2021 that have variable rate and they have caps and they have to pay them off and they're underwater and they paid a 3.5 cap and all that stuff. So there's got to be a lot of distress, but there's not really because people have been able to hold on.
Yeah.
Right? They've been able to hold on, and then people said, "Okay, well, if they're going to hold on, they're going to need that gap financing," and so that's we've talked to big name real estate private equity people who are like, this is the opportunity of a lifetime to come in and do this stuff, and then I think they've done a couple of deals because there's just people. First of all, people don't really want to pay 13% on debt,
of course,
and people have just been able to hold on, and so I don't know how that dam breaks.
Yeah,
so somewhere it has to break because. And then on the equity side, like I say, everybody is a 6 cap buyer in a 5 cap market, right? And so there are deals getting done. I talked to brokers last week who said, "Hey, we just put 2 deals under contract. They're a 4.7 cap," and I was like, "Wow."
By the way, that gap financing I've been seeing in the form of equity. To your point, when it came time for the lenders to call up, it wasn't that they got additional financing; they got more equity. They restructured some equity partnership and pay down their loans.
Yeah, or somebody will take them out somehow. Yeah, I think a lot of the lenders, especially because a lot of those deals in 2021, those bridge loans, everything were done with private credit,
right?
And they don't have the same problems that a bank has. They can just hold on to it. So
I'm curious what happens this year because 2025 definitely was that year of like, all right, we know your loans due. We can extend, so we give you another year.
Yep.
But they can't bite it further than 2025. I don't think they can, but who
the
knows?
sayings have been like, what was it? Survive till 25.
Yeah,
and then recently
horrible.
I've been hearing it'll be heaven in 27. So I was like, okay, now we're kicking it another 2 years down the road.
Yeah. But how?
Yeah, I don't know.
Some of these loans are already, especially the bridge loans that were like 3 + 1 + 1.
Yep.
You're already going into years 6 and 7.
Yeah.
I think with the banks, it's like, when do the regulators start?
Yeah, and I think the private credit guys are pretty smart. So like most people, my age or a little bit younger, lived through other cycles of this. And they saw that people, like you have to go all the way back to the 90s when all these banks made these stupid loans and then the banks went under and the government sold all that stuff at like 50 cents on the dollar.
Yeah.
And people like Sam Zell, smart people got, became billionaires with that stuff. And I think a lot of lenders saw that or what happened in the great financial crisis and they're like, we're not taking the hit so that somebody else can make $1 billion. And so I think we see a lot of deals. We've talked to a lot of these lenders and said, if you have a deal, sell it to us, us and every single other person in the industry.
Yeah,
I have a friend who runs one of those lenders and I said, hey, if you guys have any of those deals going sideways, he goes, you know how many people have called me? He goes, we had a deal that was in like, commercial mortgage alerts and he's like, we got 100 calls on our switchboard in addition to the 50 texts that I got. Everybody's asking about those. So they know better, so they know they have something of value. And I think a lot of them are being smart. And so, you probably see this in brokerage of sometimes we'll see those deals and it's like, hey, here's a bad deal. and it has a loan on it. So what the lender is going to take over the sale sort of, and they want you to make them whole somehow.
Right.
You can give them a hope note, you can restructure, you can assume the loan at 100% loan to value, and you can go on the loan, whatever. But they're not just going to take a hit.
Right.
They're not
giving it away.
Right.
Still.
They're not going to take a loss. And so that's I think the stalemate we have. And that's probably smart on their part.
I do think it's funny that they have something out of value from the fact that it was distressed and like the sponsor is underwater and the business plan has failed and whatever else has gone wrong. That is funny. But I'm curious, to your earlier point, they have something of value. It's all paper loss until it isn't. And you were talking about regulators, like there's also the pool of redemptions. And maybe, after 2008, these guys really are just so protected and they're sitting on so many reserves that they're fine. Maybe this is what the reserves were really for. I don't know. I can't imagine that you could just turn a 3-year loan into a 7-year loan and nobody asks for their money back.
Yeah, I mean, everybody's just hoping that the market corrects itself, that we'll all sort of grow our way out of this. But it doesn't seem to be happening,
Yeah, so what does happen?
I'm a big believer that, it is true in real estate that time heals all wounds. And so if you wait long enough, it probably does come back. I would assume that, we'll see some people. So, look, the people that are getting screwed in all of this right now are the investors,
the common equity investors.
Yeah, like the people that put in, $100,000, $200,000 to a deal. Those are the people that are getting screwed. They're getting wiped out, it seems like. And so I think if people grow their way out, they might be able to grow their way out of it. Or, we talk to a lot of people in the private credit space, and I think a lot of them, what's the new term everybody's using now? A super senior. So they're coming up with loan products. Yeah, they just keep around. I always say, they used to call it Kentucky Fried Chicken, now they call it KFC. Just they call something a bridge loan, it's now a super senior.
It's all marketing.
Right. But they come up with a new term, but they're coming up with a product maybe to get these people out so they can refi out of the deal. They wipe out all the equity, and then they start again.
Yeah. Let's be real. Investors expect more than a quarterly PDF. One delayed update, one missed email, and suddenly that LP's investing elsewhere. InvestNext helps you stay on top of it all, even with a lean team. Your LPs get the real-time access they want. You look like a pro without the additional IR headcount. Today's LPs have options. With the right platform, you'll be trusted, not ghosted. Learn more at investnext.com/nocap. It's sad. And I continue to see just what you were just talking about, the pref equity component. If you're an LP and you're in the deal from the very beginning and now you see they're raising a pref equity fund, you're
getting wiped out. You might as well just take the hit and move on. And I know people who invested in those deals, very smart people who invested in a lot of those deals who are just like, let's just take the hit and move on. Let's just call it a day.
And the deals, I'm seeing a lot of deals getting done now where the LPs are stepping up and they're pushing a sale.
Yeah.
And
I guess, something is, it is a 50% of something's better than 100% of nothing.
Yeah.
Right. So people are, trying to get something out of it. But I think at the end of the day, it's I wouldn't call them suckers because a lot of people are pretty smart that have invested in those deals. But those are the people that get wiped out, and the big institutions find a way to end up.
What is it that you're finding that looks interesting these days, or is it kind of a stalemate for the time being?
Not a lot. But we... I'm a believer in staying in the market. It's really tough to find deals that work right now if you're buying if you're doing a conventional real estate deal. It's tough. But we are, we have a deal we're hopefully signing the contract on this week. We're finding a few things. But I think it's just staying in the game and seeing, because I would say also if you read about it, in CRE Daily or something, it's too late, right? CRE Daily is great, but if you read about it somewhere, it's too late. So you have to be in the game, and that's kind of our philosophy is we just stay in the game. We've been looking at doing pref deals like everybody else.
Yeah.
We have bought a distressed deal or two, but they're few and far between. So we're going down all roads, but I think it's probably, again, part of being old maybe is, having seen every movie is a little bit different, but you've seen sort of a similar movie, and it's just, it'll happen. When we had in 2022, I guess it was when rates went up, everything you read was like, when are they going to cut rates? And I'm like, it's not the way it works in the business, where we had a cycle. We had almost a 10-year cycle. It was a really good cycle.
One hell of a run.
Right. It's not okay, so rates go up on Friday, we all go home for the weekend, and we come back on Monday and we start a new cycle. It takes a long time. And there's also like, nobody's going to issue a memo saying we're starting the new cycle now. So I think you just keep plowing forward.
And once you know it's happening, you're late to the game.
Yeah. So you're sort of in it, and all of a sudden
you think now's the time though?
Yeah. I mean, I think if you're not in the game now, if you're sitting on the sidelines and you really want to be in this business, you probably need to get off the sidelines.
Yeah.
I think it's time to be, looking at deals, offering on deals, and being in the game. And the thing that's really different now from a couple of years ago when it was easy. I mean, all you had to do to get a deal was just pay more than anybody else. I mean, I guess you could always win a deal by paying more. But
that was super easy for a couple of years.
Yeah, but it was always like you could just, it was just an auction basically.
Right.
But now the deals are much more complicated. And again, you could tell me probably more than I can tell you, but it seems like that every one of these deals, if it's listed or it's not listed, but it's still sort of listed.
Oh yeah, I love the off market. Yeah. Well, hello, if it's off market and I'm seeing it, it ain't off market.
Right. Especially if you get it from a broker. It's like off market deal.
It's a silly game we all play.
Yeah. But also investors love that when you say it's off market.
Totally.
But it seems like somebody has a deal. They say, okay, take a look at it. Tell me what it is. They have to go through the 7 stages of grief on the deal. So you're going to go back to them. You're going to tell them, they say, we want $45 million for it. And I'm like, well, it's worth 38. And they're like, well, that's ridiculous. And then, they go through that. And then finally they get to the acceptance point. But it takes them a while. And so it goes from 45, I'm like, I'm at 38. And then they're like, well, we're not going to sell it. I'm like, okay.
And it's like, we got another buyer who's there. And then, well, they couldn't do it.
Yeah, right. They flamed out.
Yeah.
And so, okay, if you can get to 43, we'll do it. And I'm like, we're still at 38. And then, three iterations later, they're like, okay, can you do it at 38? And I was like, well, send us some new numbers. And then we're like, oh, well, now we're at 36 because the occupancy went down. But it's just, it takes a while. But it's, I call it the hang around the hoop strategy.
It's a real thing. And I think a lot of deals go to market right now at, this has always been the case, at sort of aspirational pricing to an extent. But now I think it's happening where I think deep down sellers understand that it is very aspirational. And maybe you get that buyer, maybe it happens, but you got to be realistic.
Yeah, there's also in multifamily, obviously, there's a bifurcation in the market too. Certain kinds of deals, I think, like there's a sweet spot. It's like if you have a deal that's maybe 10 years old, new construction's its own little world there because I think people are on construction loans and they're always like, it's below replacement cost, but
everything's below.
I'm not sure how you really.
It's funny shtick now.
What book is the replacement cost in? I don't know. I don't have that book, but then it's like, but deal that's maybe like 10 years old that they haven't done any renovations because they didn't need to.
Right.
We had one of those deals last year, and we put it on the market, and we had 60 offers, and it was every name brand you heard of. Like there's money for that, and people are really into that. But then the old stuff, like that is a whole nother world. And people are like, oh, I don't want to touch anything that's old.
What's old to you right now?
Well, me. No, I would say what's old to me is probably something in the 70s and I think most people are saying 90s and newer is okay.
Yeah.
Everybody we talk to. But I would in 80s deal. I still kind of believe, I think that's probably also sort of the herd mentality, whatever cliche you want to use, throwing the baby out with the bathwater, whatever it is. Like, there are deals that are older that still work. It just, every deal's different.
Every deal's different. And we were just talking about in some markets, a 1960s vintage deal might be built really well, and brick and stone
infill location.
Versus, in Texas, you have a lot of the stick-built stuff.
People tend to forget that your prime location, like what's the premium that you should be paying? And maybe the layouts work and it's got washer dryers.
You have a lot of properties that, their lifespan was supposed to be 50 years. And we're coming up on 80.
Yeah. I mean, some of the Texas stuff, the old, that 70s, 80s stuff just looks really dated now. And, I'm not sure.
I know.
Yeah. But then again, I guess if you have the right strategy, maybe,
It's all comes down to you buy it right, I suppose.
Yeah. I mean, we actually, say we have institutional equity and we went with a case study back to them and said, here's some older deals. What do you guys think? And they're like, I mean, if you can buy this at $75,000 a unit, how could you lose money on it? I was like, I don't know, maybe you could. But
I tend to agree. To agree. Let's talk about something that I think is kind of a funny story. So at one point, you're starting out in your career, and you're really close to being like one of the founders of Starwood.
Yeah. Well,
what happened
I don't want to overstate that, especially if Barry's
let's just
listening.
embellish so it sounds better.
Yeah.
We actually have Barry on the line.
Yeah, we're plugging him in. He doesn't know who I am, so he'd be like, "Who the hell is this guy?" But yeah, so when I was graduating from business school, I got my MBA in the early '90s, and that was not exactly a good time to be going into the real estate business. So I was looking for, just trying to find a job. And actually, I wasn't even sure I really cared about being in real estate. I just wanted a job.
Yeah.
And so, you talk to everybody, you do it. And so a friend of mine had his boss, my friend lived in Chicago. His boss, I think, was friends with Barry Sternlicht or something, who was just a guy at that point.
Sure.
And he was so they were starting Starwood then, I guess. But he said, my friend calls me, he says, "Hey, my boss has a friend. He's starting this company, and they need they're thinking about hiring like a young guy." So I was like, I'm not picky right now. I just need a job. And so I talked to him, and they're like, "Okay, why don't you come up to Chicago? Maybe spend a day with us, whatever." So I went and spent a day with them, and they're like, "Yeah, seems like you know what you're doing, or you're fine." They're like, "But we can't. We're a small company, so give us a little bit of time, see if we can get our act together to get some money together, hire somebody, whatever." I was like, "Okay," I was like, I'm looking for a job. So a little bit of time goes by, and, I talk to other people. I end up getting an offer from a company, the one I ended up working for. And they say, they're like, "Okay, can you start in a couple of weeks, whatever." So then I get a call from these guys, and they're like, "Hey, I think we could do it if you can give us another 3 weeks or so." And I was like, "Are you sure it's 3 weeks? Because, I have another offer." And they're like, "Yeah." And then I'll hear from them for a while. And then I say to my father, he goes, "Well, look, this is the biggest company in this industry. And these are like 3 guys.
Yeah,
who the hell are these guys? Right?" And so he's like, it's a bird in the hand. Take the bird in the hand, especially with the big company. So I take the other job, and then they call me back. They're like, "Okay, we think we're ready." I was like, "I took another job." So that company turns out to be Starwood.
There you go. You could be number 2.
Right. But yeah, as I say, Barry Sternlicht, I'm sure has no idea who I am.
People love these stories. Actually, he does, and he's heartbroken still.
Yes. He really missed out. As you can see, it really impacted their growth.
I love these stories. Well, it sounds like it still worked out for you too.
Yeah.
And so, what's going on inside your guys' portfolio right now? And are you structuring? Do you ever structure funds, or are these held within a fund?
So we generally work with sort of programmatic joint ventures. Yep. So we have a couple of programmatic joint ventures that we have, and we've been around for a while, so we did not do any bridge loans. We paid off our last variable rate loan in 2021. So I don't know that was Nostradamus or anything. That was just it was time to pay that loan off. But we had no exposure to any of the short-term financing or thing. We've done all the deals we've done have been long-term fixed rate financing. Doesn't mean that we don't sell or do value add deals. We have a fund or a JV or whatever that does value add. Doesn't mean that and we bought some deals in 2021, 2022. But they were not really big value add propositions. So, they're doing well, they're doing fine. I mean, obviously we paid a pretty high price for them. And so, but we don't have any of the issues that, we hear the horror stories about. We're pretty doesn't mean that we don't, and especially my partner, who does asset management would be like, it's a nightmare. But yeah, it's pretty stable. We don't have any real issues, and we don't have any big, I think we have a loan or two maturing next year that from properties we bought 10 years ago. Yeah. That we're running out the clock on the loans on, and those are probably fine. So
the news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
Were these intended to be core deals? You said there's no real value add propositions.
So we have sort of, I would say we have 3 pockets of deals, if you want to call them. So we have a joint venture, I guess you want to call it a fund. I think it's actually structured as a fund. Citibank is the LP on that, and that is what we call housing preservation. So that's sort of in there. So when I gave you my 60 to 120% of area median income deal, that's at 60%. So
does that work for their CRA?
It was actually sort of a social impact thing that they did. And so so those are sort of affordable deals, and those are sort of longer term holds, because the play on those tends to be that we bought properties where the tax credit compliance period was coming to an end. Okay. And we could sell at the end of it, we can sell the dream that, hey, you can make this a market rate deal. Yeah. And we bought some, what we called naturally occurring affordable housing. So those are more just conventional deals, but again, with a pretty long timeline. And then we have a joint venture with a group called GCM Grosvenor, and they advise pension funds, and that's to buy core value add. And so the deals we have with them are a little bit more opportunistic, but again, they have the runway, I guess, to be longer term holds.
Yeah.
And then we have a relationship with a family that's been investing together for decades and decades and decades, and they buy core-ish new construction kind of stuff.
More wealth
and
preservation.
So that stuff is mostly, anywhere from 0 to 10 years old, depending on when we bought it. And so, and those properties are just literally a long-term hold. They just buy it, forget about. Well, they don't forget about it because they want their check every month. But, but buy it, don't think about it, and then sell it at 10 years. Do an exchange typically, and then rinse, repeat, because their basis is from some property they bought in 1968 that they would have to pay more than they would get in taxes.
So how much is roughly under management between all those components?
Dollar-wise, that's a good question. I think it's about $500 million, but something, I should know that off the top of my head. But
you could just make it up. Too.
No one's going to verify.
I love it when you have these groups who brag about how many units they have, or their
it's
AUM.
all squishy.
What does that mean?
It's all squishy. Yeah,
totally.
It's tough when you only have one partner, though. I think they could verify it pretty fast.
Probably.
Yeah, no, it's all the stuff in our business tends to be pretty squishy. It's like what cap rate is that? I was like, I don't know. What number you cap it?
That's one of my big pet peeves. Yeah. It's like, what cap rate is it? Well, what numbers are you using for the cap rate?
Yeah, we see every deal now. It's like, it's a 6 cap. I was like, on which number? And then I was like, it's a 6 cap when you get rid of all the delinquency and you do all this stuff. But right now it's
tax is not adjusted. Insurance is still out.
So what's getting you excited right now, if anything? Obviously, we spoke about it. It's tough to see stuff that pencils kind of where it used to be 10 years ago. But what are you still bullish on, optimistic about?
Yeah, I mean, I'm I would say this. I'm long term very bullish on multifamily. I think it's a good, the sort of the setup of multifamily is really strong. Like, okay, so we have all this new construction now, but there's not going to be a whole lot pretty soon. When all these deals are finished, it's not like there won't be any, but there'll be more normal levels of that. There's a huge shortage of affordable housing in America, so people need apartments. The demographics are good. There's a lot of renters out there. It's so look at where interest rates are on a single family mortgage. Like, you can't afford to buy single family. So all of the setup for multifamily is really strong. But I think that setup sort of comes into play in 2 years or something like that. So I would just say I'm long-term bullish on it, and I think that if you can find deals now that will stand the test of 2 more years, and it's interesting because these different investors that I talked about, they all have different mindsets. So like our family group, like, they want cash flow and they want their money every month. I mean, they're and so we were going to buy a property for them last year. We'd sold something. We had some money. We were going to buy a new construction property, and we had primarily bought for them in, Texas, North Carolina, the hot markets. Mm-hmm. But the value proposition in those markets right now is that it's going to be better in a couple of years. And so if you buy something now, it's below replacement cost. It's a good basis, all that stuff. But that's not. You can't write a check on that today.
It's like negative leverage.
Yeah. And so we dusted off our little model and we said, how about, what are some markets where we could actually get some cash flow? So we bought a property in Indianapolis. And there was new construction in Indianapolis, but not nearly as much. The rent has gone up every year in Indianapolis over the last 20 years. And so we found a property there. And so we bought them a new construction property in Indianapolis. And since we bought it, it's been 96% occupied, and it it's hit the budget on throwing off the cash. Mm-hmm. So for them, that works perfectly. And that's kind of, today, that's what we do. Now, for our institutional investors who are, professional real estate people, we can say, hey, look, this property is a good buy. It's in, Charleston, which is a really good market. There's a lot of new construction there now, but we're in a good spot here. And maybe if we have to wait, a year or two it's probably not going to throw off a lot of cash, but we can get to a good number in a year or two.
And you're just counting on
in the future
growth and occupancy to pick back up.
And we're very conservative, so we're not going to project it's going to be 8% rent growth in 2 years or whatever. But if we can, on normal assumptions, say, hey, look, in 2 years this is going to be a pretty good deal, and we can, and we're in a good spot. I think that's a defensible position right now.
Yeah.
So it's interesting. The thing that everybody in the institutional world seems to focus on right now is the exit and the exit pricing. So we get pushback less right now on, what's the rent growth or the new construction or stuff like that. But a lot of pushback on what is the
terminal cap rate.
Yeah. What is your exit cap? What's the value at exit? Is that really defensible? Or are we banking this whole deal on some kind of unrealistic exit? It's a good point, and it's a fair metric.
Well, it's one of those levers you can pull that just could change the deal.
Yeah, I think so also
quick.
back in the day, everybody back in the day being like 2 years ago, everybody was manipulating that model and changing the exit cap and
totally.
say, well, the IRR is 20%, or something like that, and now people are hip to that because it actually means something.
Yeah.
So
are there deals where you're kind of keeping them flat? They're
few and far between. Yeah, they're few and far between. As say, I think we're if we look at 100 deals now, the deals seem to ebb and flow. Like it's been it's been busy, then it's been really slow. And we're in the summer now,
that as well.
So all of a sudden it's a little slow. But we're banging our head against the wall. So one out of every 50 works or whatever the right number is. So we're finding a few of those but most of them don't work, to be honest with you. And we're staking our claim. We'll plant our flag and say, if you come to, going back to our 7 stages of grief or whatever, when you hit the acceptance point, call us.
Yeah. Makes sense.
Yeah.
Makes sense.
Yeah.
Well, cool. I mean, I don't really have anything else, Jon. I mean, it was nice kind of getting to know more about you and the company and what you're seeing out there.
What are you hoping happens next year?
I'm hoping. You know what? I hope for stability. I don't. So I think it's unrealistic. People think like I presume there's not anybody now that's thinking like, hey, it's going to go back to the way it was in 2021.
Right.
I presume that has been flushed from everybody's system. But that was a thing for a while. It's like, when we get the rate cuts, it'll be, I was like, it's not going back to the way it was. And I think what we just need is stability. Like if we just know what the 10 year is going to be, or we know what everything is, we can have a much more efficient market, and then we can just do this. Look, all the people that got into real estate and commercial real estate and multifamily, whatever, because they thought it was quick money or it was easy or it was really cool or whatever. They might still be in it, but they're probably not going to be in it for long.
I would think we'd have less opportunity in an efficient market, though.
Yeah.
Right?
Well,
so if it gets any more efficient than it is now, it's like then we're all bidding the same.
It's just all locked
price.
up right now.
Yeah,
I think that's.
I think what markets hate is uncertainty.
Sure.
And so, and there's never certainty. Like nobody's ever going to tell you exactly what it is. But I think just some level of predictability, so we can have the inputs. There's always multifamily, especially, is a very inefficient market. I mean, what is it? The largest owner of multifamily owns less than 1% of the market. So there's a lot of inefficiency. There's always deals out there, and I think just it's really just getting the capital moving again.
Yeah.
Once we get that, then I think we're back in business.
Yeah. All right. Well, cool. Well, on that note,
that's great to hear that.
Let's all hope that happens here sooner than later.
Of course, because I said it'll definitely happen. Take it to the bank.
Thanks for coming on, Jon.
Yeah, thanks for having me. I appreciate it.